The Piotroski F-score and accounting ratios. The Piotroski F-score is a rating of a company from 0 to 9, and as the Piotroski F-score goes up, the financial position of the company is better. Basically, what the Piotroski F-score is it's a metric that we use to determine whether a company's return on investment is high, with 9 being the best and 0 being the worst. And 0 usually indicates a loss of investment. There are 9 criteria based on profitability, leverage, and operations that the company must fulfill in order to calculate its Piotroski F-score. And we basically start off with a base value of 0, and as the company fulfills each criteria, we add 1 to that base value. The first criteria is profitability. The first percent of criteria is determined by profitability. And the first criteria is that return on assets must be positive. This criteria basically exists to screen out loss-making companies. The second criteria is that the operating cash flow is positive in the current year. This criteria filters out companies that rely on their own cash reserves or outside debt finance. The third criteria is that the company must have a higher return on assets in the current year over the previous year. Now, this criteria filters out companies where asset growth is outstripping profit growth. The fourth criteria is that cash flow from operations is greater than net income. This criteria is that may be engaging in collective manipulation. Now, here we get to our second set of criteria, with the fifth criteria being that there's a lower ratio of long-term debt in the current period compared to the previous year. And this criteria intends to filter out companies that are taking on debt finance operations because of shortfalls in free cash flow. So maybe think of a company like Lehman, right? They might not be able to fulfill this at the beginning of the downfall. The sixth criteria is there's a higher current ratio this year than compared to last year. This criteria attempts to weed out companies that have decreasing working capital efficiency. The seventh criteria is that the company has issued no new shares in the last year. In this criteria, we've had companies that are reliant to than it is last year. This criteria is pretty self-explanatory. It intends to weed out companies that may be coming under pricing pressure from competitors. The ninth criteria is that asset turnover ratio is higher than this year than last year. This criteria is to weed out companies that have declining asset efficiency. So we will solve an example problem to sort of show and explain how the Piotroski F-score works. So from this chart right over here, we need to determine the Piotroski F-score. And so we need to go to our first set of criteria, which is profitability. Our first criteria is that return on assets is positive. So if we check return on assets on our example company, we see that return on assets is indeed positive, which basically means that this is correct. This criteria has been fulfilled by our example company. So obviously, this criteria is indeed fulfilled. Our second fact criteria is that is positive. So if we go over this, whereas in 2019 it was 0.37. So this criteria is not fulfilled because the current ratio, the return on assets ratio is less than it was in the previous year. So because of this, we're going to mark an X because that criteria is not fulfilled. Our fourth criteria is that cash flow from operations is greater than net income. So if we go to the most recent year, 2019, according in this graph that you see, this table, we see ratios is so obviously our company has indeed does have less debt compared to last year. So we will mark this as yes. This criteria is fulfilled. Our sixth criteria is that there's a higher current ratio this year compared to last year. This one is fulfilled as well. The current ratio is higher in 2019 compared to 2018, with our 2019 current ratio being 1.24 and our 2018 ratio being 1.12. So we will mark this as yes. Our number 7 is that we have no new shares issued last year. And so here we're going to assume that we haven't issued any new shares. Our company hasn't issued any new shares, as the problem doesn't tell us whether it doesn't tell us that we've issued any new shares. So we will mark this as X. Our 8th criteria is that gross margin is higher this year than it is last year. And so if we look at gross margin is actually less in 2019 than it is in 2018, as gross margin in 2019 is 66.3%, whereas in 2018 it's 73.3%. So we'll mark this as no. And our 9th and final criteria, asset turnover ratio, is higher this year than it is last year. So if we go to our asset turnover ratio, we do see that our asset turnover ratio is greater than it is last year. So we will mark this as yes, this criteria is fulfilled. And from here, we add up all of the criteria that have been met. And so if we count 1, 2, 3, 4, 5, our final answer will be a Piotroski F score of 5. Yeah, and I accidentally covered the lettering, but that's all right. And so next we're going to go on to DuPont analysis and ratios, which is pretty simple. So basically, the DuPont formula breaks down a ratio called the return on equity ratio as the return on assets multiplied by net profit margin. The full formula is net income over shareholders' equity. And the net profit margin, as well as the return on assets ratio, as I said earlier, are multiplied in order to equal that ratio, return on equity. And to kind of break it down even further, to break down this formula further, the net profit margin is net income divided by sales, and the return on assets is sales divided by our average assets, our total assets, right? And so those two obviously multiplied together get you your return on equity ratio. And to assess our understanding, we'll do a practice problem really quick. So if the net profit margin is 6% and the return on equity is 12%, then what is the return on assets equal to? Well, as we mentioned earlier, ROE is equal to return on equity, or return on assets, which I'll mark as ROA, times the net profit margin. And so basically this problem requires us to do some algebra. 12% equals X, which is our return on assets, multiplied by 6%. So what we would do is obviously divide 12% by 6% to get our return on assets, or return on assets, yep. And so this gives us a final answer of 2%, which is what our ROA equals. And with that, we conclude our lesson.